For nearly 2 years, Wall Street had the same concern about Microsoft. Not whether the company could build AI, but whether its massive AI investment would ever generate the returns investors were expecting. Every earnings report raised the same questions. Was Microsoft spending too much? Was the payoff still too far away? Then came this quarter. The financial results were certainly strong, but that wasn't what changed the market's mind. Instead, investors saw something they had been waiting for all along, the first convincing signs that Microsoft's AI strategy may finally be turning into a sustainable business advantage. So, what exactly changed? And why did Wall Street suddenly become far more confident about Microsoft's future? Let's break it down. Microsoft has delivered strong financial results for years. Revenue kept growing, profits remained healthy, and its cloud business consistently outperformed many competitors. None of that was new. What was new was the market's reaction. For months, investors had become less interested in earnings beats and more focused on one question: was Microsoft's massive AI investment creating real economic value, or was it simply becoming a more expensive growth story? This quarter didn't eliminate every concern, but it offered something the market had been missing, a stronger reason to believe that Microsoft's AI strategy was beginning to translate into durable growth. And that's why this earnings report felt different from the ones before it. For years, Microsoft has built a reputation for delivering consistent growth. That wasn't the issue. The real concern was whether AI would become a profitable business, or simply one of the most expensive investments in the company's history. Microsoft committed billions of dollars to build AI infrastructure, expand data centers, and support the next generation of computing. Investors understood why those investments were necessary. What they didn't know was when those investments would begin producing meaningful financial returns. That's why every earnings report became a test, not of Microsoft's ability to beat estimates, but of whether there was new evidence that AI was moving closer to becoming a sustainable growth engine. And this quarter, many investors believed they finally saw that evidence. So, what changed? It wasn't just another earnings beat. This quarter gave investors something they had been waiting for: a stronger connection between Microsoft's massive AI investments and its future growth. For the first time, the market could point to multiple signals suggesting that AI demand wasn't slowing, enterprise customers were continuing to invest, and management sounded increasingly confident about the road ahead. None of these signals alone would have changed investor sentiment. But together, they painted a very different picture. Instead of asking whether Microsoft was spending too much on AI, Wall Street started asking a new question. How much growth could these AI investments generate over the next several years? That shift in thinking may have been the most important takeaway from the entire earnings report. One of the biggest reasons investors became more confident came down to a single signal. Azure's growth came in stronger than Wall Street expected. Now, this wasn't important simply because the percentage was higher. It mattered because Azure has become one of the clearest indicators of enterprise AI demand. If businesses were cutting AI spending or delaying adoption, investors would likely have seen it reflected here. Instead, the results suggested that companies were still investing despite an uncertain economic environment. That changed the market's interpretation of Microsoft's AI strategy. The question was no longer, is demand slowing? It became, could AI adoption still be in its early stages? And that's a much more bullish question for long-term investors. Strong numbers may grab the headlines, but experienced investors also pay close attention to management's outlook. Because earnings tell you what happened. Management tells you what they believe will happen next. This quarter, Microsoft's leadership didn't sound like a company becoming more cautious. Instead, they reinforced their commitment to AI, even while continuing to invest aggressively in new infrastructure. That mattered because it signaled confidence, not only in customer demand today, but also in the long-term return on those investments. For Wall Street, this wasn't just another optimistic forecast. It was a sign that management believed the AI opportunity was becoming more predictable, more durable, and more profitable than many investors had expected just a few quarters ago. For almost 2 years, the market focused on one thing: how much Microsoft was spending on AI. Every new investment raised the same concern. Would these massive costs eventually hurt profitability? But after this earnings report, the conversation began to change. Investors were no longer looking only at the size of Microsoft's AI investment. They were paying much closer attention to what those investments were starting to produce. That's an important difference. Once investors believe an investment is generating sustainable returns, they become far more willing to accept higher spending. In other words, AI spending itself didn't become smaller. The market simply became more confident that those investments were creating long-term value. And that change in perception may prove far more important than the earnings beat itself. One of the biggest insights from this quarter wasn't inside Microsoft's financial statements. It was inside customer behavior. Over the past year, many companies approached AI cautiously. They ran pilot projects, tested different models, and looked for practical business applications before making larger commitments. This quarter suggested that behavior is beginning to change. More enterprise customers appear to be moving from experimentation to broader deployment. That matters because large-scale deployment creates recurring demand, not just for AI tools, but also for the infrastructure needed to support them. In other words, Microsoft's stronger performance wasn't driven by hype alone. It reflected a gradual shift in how businesses are adopting AI. And that's exactly the kind of change long-term investors have been waiting to see. For several quarters, Microsoft's rising AI investment was one of the biggest concerns on Wall Street. The fear wasn't that the company couldn't afford it. The fear was that returns would take much longer than expected. This quarter didn't suddenly reduce Microsoft's spending. In fact, management made it clear that AI investment would remain aggressive. What changed was investor confidence. The stronger business momentum, combined with management's outlook, suggested that those investments were beginning to translate into meaningful growth. That's a very different investment story. When investors believe returns are becoming more visible, high capital spending is no longer viewed as a warning sign. Instead, it starts to look like the foundation for the next phase of long-term growth. Wall Street has heard Microsoft's AI vision for nearly 2 years. The strategy was ambitious, the opportunity was enormous, and management consistently expressed confidence in the long-term potential of AI. But investors wanted more than confidence. They wanted execution that supported the vision. This quarter, those two finally started to come together. The business performance reinforced management's outlook, making future growth projections feel more credible than they did just a few quarters ago. That's an important shift. Markets don't reward optimistic guidance alone. They reward guidance that is supported by visible execution. And that's one of the biggest reasons investor confidence improved after this earnings report. For years, Microsoft asked investors to be patient. The company invested heavily in AI infrastructure long before the financial benefits became visible. That strategy always carried execution risk. If customer adoption had slowed, those investments could have become a significant drag on future returns. But this quarter suggested something different. The business is beginning to reach the stage where earlier investments are supporting stronger growth rather than simply increasing costs. That's a meaningful strategic shift. It suggests Microsoft may be entering the next phase of its AI strategy, not proving the technology works, but proving the business model can scale. And that's the difference Wall Street has been waiting to see. While this quarter strengthened investor confidence, it didn't answer every question. Wall Street is now looking for consistency. If Microsoft's AI strategy is truly entering a new phase, investors will expect these improvements to continue over the coming quarters, not just in revenue growth, but in the company's ability to translate AI investment into durable financial returns. That's why the next few earnings reports may become even more important than this one. They will determine whether this was simply an exceptional quarter, or the beginning of a long-term shift in Microsoft's growth story. For now, the evidence is becoming more encouraging. But the market will continue looking for proof that this momentum can be sustained. So, why did Wall Street suddenly become more confident? It wasn't because Microsoft delivered another strong earnings report. It was because this quarter provided something investors had been waiting for, a clearer connection between Microsoft's long-term AI strategy and its financial performance. The market saw stronger signs that enterprise AI adoption is accelerating, that management's confidence is being supported by execution, and that years of heavy investment may finally be translating into sustainable growth. That's why this earnings report felt different. It didn't just improve Microsoft's quarterly results. It strengthened the belief that one of the biggest AI investments in corporate history is beginning to produce the returns investors have been waiting to see. And that's the story Wall Street is likely to keep watching over the next several quarters. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.